Ladies and gentlemen, your favorite Asian analyst here. There's a number that flashed across Bloomberg terminals this week that made very few headlines in the Western financial press. $1.7 billion. That is the amount of capital that foreign institutional investors pulled out of Indian equities in a single session on January 14th, 2026. The largest single-day outflow in over 8 months. To the casual observer, this looks like routine profit-taking. India had a good run. The Nifty 50 was up. Investors are rotating. Nothing to see here. Move along. But if you know where to look, if you understand the language of capital flows in emerging markets, this is not profit-taking. This is not rotation. This is evacuation. And the smart money, the sovereign wealth funds, the pension giants, the family offices that manage generational wealth, they are not selling because they think India is overvalued. They are selling because they have seen this movie before and they know how it ends. We are going to conduct a forensic breakdown of what is really happening beneath the surface of the Indian market. We are going to analyze the data that the financial media is too lazy or too compromised to investigate. And by the end of this briefing, you will understand why the FII Exodus from India is not a blip. It is a signal that the great emerging market trade of the 2020s is entering a dangerous new phase. And if you are holding Indian assets right now, you need to understand the protocol. Let's start with the number. $1.7 billion in a single day, January 14th. To understand the scale, we need context. In the entire month of December 2025, FIIs pulled roughly $3.8 billion from Indian equities. In the first 2 weeks of January 2026 alone, they have already yanked out over $4 billion. The pace is accelerating. Now, the official narrative, the one you will hear on CNBC India or in the Economic Times, is that this is about valuations. They will tell you that India's price-to-earnings ratio is stretched. The Nifty is trading at 23 times earnings compared to the MSCI Emerging Markets Index average of 12 times. Therefore, sophisticated investors are simply de-risking. They are selling expensive India and buying cheaper alternatives like Indonesia or Vietnam. This is a surface-level analysis. It is what they teach you in business school. And it is designed to keep you calm while the exits are being quietly bolted shut. Let's look at what they are not telling you. The real story is not about valuations. It is about currency. It is about debt. And it is about a macroeconomic trap that India walked into willingly over the last 18 months, a trap that is now snapping shut. The Indian rupee hit an all-time low against the US dollar on January 10th, 2026, 84.75 rupees per dollar. This is not a normal depreciation. This is a structural break. The Reserve Bank of India, the RBI, has spent over $100 billion of its foreign exchange reserves in the last 12 months trying to defend the currency. They are selling dollars and buying rupees to prop up the exchange rate. But the selling pressure is relentless. Why? Because India runs a structural current account deficit. They import more than they export. Specifically, India imports 85% of its crude oil. And oil, as you know, is priced in dollars. When the rupee weakens, the cost of importing energy explodes. This creates inflation. Inflation forces the RBI to keep interest rates high to prevent runaway prices. High interest rates kill economic growth. Slower growth reduces corporate earnings. Lower earnings justify the FII selling. And the selling creates more downward pressure on the rupee. It is a doom loop. But here's the part that should terrify anyone holding Indian equities. The RBI is running out of ammunition. India's foreign exchange reserves, which peaked at $675 billion in September 2024, have now fallen to approximately $620 billion. They burned $55 billion in just 16 months. At the current rate of depletion, if the rupee continues to weaken, if oil prices spike, or if there is a sudden geopolitical event that triggers capital flight, India has maybe 12 to 18 months of reserve coverage left before they face a balance of payments crisis. Let me say that again. India, the darling of the emerging market world, the country that was supposed to be the next China, is potentially 12 to 18 months away from having to go hat in hand to the International Monetary Fund for a bailout. The smart money knows this. That is why they are leaving now. Now, the apologists will point to India's strong domestic consumption story. They will say, but India has a growing middle class. It has a young population. It has digital adoption. It has UPI payments and fintech revolution. All of this is true, but none of it matters if the currency collapses and foreign investors cannot get their capital out. You must understand the mechanics of how FIIs operate. When a foreign fund buys Indian stocks, they are making two bets simultaneously. Bet 1, the stock will go up in rupee terms. Bet 2, the rupee will hold its value or appreciate against their home currency, usually the dollar. If the Nifty goes up 10%, but the rupee falls 12%, the foreign investor has lost money in dollar terms. This is currency risk. And right now, the currency risk in India is erasing all equity gains. Let's run the math. In calendar year 2025, The Nifty 50 index was roughly flat in rupee terms. It ended the year almost exactly where it started. But the rupee depreciated approximately 3.5% against the dollar over the same period. So a dollar-based investor in Indian equities did not break even. They lost 3.5% plus whatever fees and transaction costs they incurred. This is a negative real return, and negative real returns trigger redemptions. Redemptions trigger selling. Selling weakens the currency further. The doom loop accelerates. But there's a deeper, more sinister pattern at play here. And to see it, we must zoom out and look at the flow of foreign capital into India over the last 5 years. From 2020 to 2023, India was the golden child. FIIs poured money into the market. The narrative was clear: China is uninvestable. Xi Jinping has cracked down on tech. He has centralized power. The regulatory environment is hostile. The US-China decoupling means global supply chains need an alternative. That alternative is India. Modi is business-friendly. India has democracy. India has rule of law. India is open for business. This was the India story, and the capital flowed. Tens of billions of dollars. The Sensex doubled. Wealth was created. Fortunes were made. But here is what nobody wanted to talk about. That capital inflow had a dark side. It inflated asset prices. It created a bubble in mid-cap and small-cap stocks. It encouraged corporate India to borrow heavily in dollars. And it made the Indian economy addicted to foreign capital to finance its deficits. By 2024, the cracks started to show. The earnings growth that justified the valuations was not materializing. Corporate India was struggling with margin compression. Input costs were rising. Wage inflation was creeping up. And crucially, the export story was not taking off. India's share of global goods exports has barely moved. They are stuck at around 2%. Compare that to China at 18% or Vietnam at 4% and growing. India has not become the factory of the world. It has become a consumption market funded by foreign capital inflows. And when those inflows reverse, the whole structure wobbles. Now we come to the smoking gun, the data point that Wall Street does not want to discuss openly. The carry trade unwind. For the last 2 years, global investors have been running a massively profitable trade. Borrow yen at 0% interest in Japan, convert to dollars, use those dollars to buy high-yielding Indian bonds or Indian equities with dividend yields, pocket the difference. This is the carry trade. But in 2025, the Bank of Japan started hiking rates. The yen started to strengthen. Suddenly, the cost of borrowing in yen went up. And the trade that worked beautifully for 2 years started to blow up. Investors had to unwind. They had to sell their Indian positions. They had to convert rupees back to dollars. They had to buy yen to pay back their loans. This creates a triple whammy of selling pressure. Equities down, rupee down, yen up. The January 14th sell-off was not random. It was part of a broader global deleveraging event tied to the yen carry trade. The Reserve Bank of India knows this. The government knows this. But they cannot say it publicly because if they admit that a significant portion of the FII inflows were speculative leverage rather than long-term investment, it would trigger a confidence crisis. So instead, they issue bland statements about volatility and talk about India's strong fundamentals. They are managing perception while the foundation crumbles. Let's talk about the political dimension because markets do not exist in a vacuum. India is heading into a critical period politically. There are state elections throughout 2026. The Bharatiya Janata Party, the BJP, Modi's party, is facing headwinds. The opposition has unified. There are concerns about economic inequality. Youth unemployment is high. The farm sector is restless. If the BJP loses key state elections, it signals political vulnerability. Political instability in an emerging market is poison for foreign capital. FIIs will not wait to see how the politics play out. They will do risk first and ask questions later. Furthermore, there is the geopolitical wildcard. India is walking a tightrope between the West and the East. They are part of the Quad with the US, Japan, and Australia, but they are also part of BRICS with China and Russia. They buy Russian oil at a discount. They trade with China despite border tensions. This neutrality worked when the world was stable, but we are entering a period of bloc formation. The US is pressuring allies to pick a side. If India is forced to choose, either choice alienates a major trading partner, and FIIs hate uncertainty. They price in the worst-case scenario and sell. So what happens next? Let's game out the scenarios. Scenario 1, the best case, the RBI successfully stabilizes the rupee. The government announces structural reforms. Corporate earnings rebound. FII selling tapers off. The market finds a bottom and slowly recovers. Probability, maybe 20%. Why so low? Because none of the underlying structural issues are being addressed. India is not fixing its current account deficit. It is not reducing its oil dependency. It is not accelerating exports. Scenario 2, the muddle through. The rupee continues to weaken slowly. The RBI burns through more reserves. FII outflows continue but do not accelerate into panic. the market drifts lower. Domestic investors, mutual funds, insurance companies step in to absorb some of the selling. India avoids a crisis, but experiences a lost decade of stagnant returns. Probability, maybe 50%. This is the most likely outcome. Slow bleed. Not spectacular collapse, but not recovery either. Scenario 3, the nightmare. A geopolitical shock, maybe a conflict in the Taiwan Strait. Maybe an oil price spike due to Middle East instability. Maybe a US recession that triggers global risk off. In this scenario, FII selling turns into a stampede. The rupee breaks 87, 88, 90 to the dollar. The RBI burns through its remaining reserves in weeks. Capital controls are imposed. India goes to the IMF. The market crashes 30 to 40% in dollar terms. Probability, maybe 20 to 30%. Low probability, but non-zero. And the consequences are catastrophic. Here is what the data is telling us. The smart money is not waiting to find out which scenario plays out. They are reducing exposure now. The 1.7 billion outflow on January 14th was not panic selling. It was orderly, calculated de-risking. The kind of selling that happens when the risk-reward ratio no longer justifies the position. And this brings us to the question everyone is asking. What about the domestic flows? What about the SIP, the systematic investment plans, where millions of Indian retail investors put money into mutual funds every month? The narrative is that domestic flows will absorb the FII selling. That India has a homegrown investor base now that can support the market. This is partially true. Domestic flows have been strong. In 2025, retail investors poured roughly $2.5 billion per month into equity mutual funds through SIPs. This is real money. But here's the problem. Domestic investors are price takers, not price makers. They buy at whatever price the market is at. They do not set valuations. FIIs set valuations. When FIIs sell aggressively, they push prices down. Domestic investors then buy at lower prices. But if the selling continues, if the rupee continues to fall, eventually even domestic investors get scared. They stop their SIPs, they redeem their funds. And then you have sellers on both sides with no buyers. That is when markets crash. We are not there yet. But the trend is clear. FII selling is persistent. Domestic buying is slowing. The buffer is shrinking. So what is the protocol? How do you position yourself in this environment? Rule 1. If you are a foreign investor holding Indian equities, you need to seriously reevaluate your exposure. Ask yourself, am I being compensated for the currency risk? If the rupee can fall another 5 to 10% from here, and it can, then your equity returns need to significantly outperform just to break even in dollar terms. The math does not work. Rule 2. If you are an Indian domestic investor, do not blindly follow the SIP mantra. Rupee cost averaging works in a bull market. In a bear market, it just means you are buying more of a depreciating asset. Be selective. Focus on companies with dollar revenues, exporters, IT services, pharma. These companies benefit from a weaker rupee. Avoid domestic consumption plays. Avoid highly leveraged real estate or infrastructure companies. Rule 3. Watch the foreign exchange reserves. This is your early warning indicator. If reserves fall below 600 billion, that is yellow alert. If they fall below 550 billion, that is red alert. At that point, capital controls become a real possibility. And if you're stuck in India with capital controls, your money is trapped. Rule 4. Diversify your currency exposure. If you are sitting in rupees, find ways to get exposure to dollars, gold, or hard assets. The rupee is in a structural decline. This is not a short-term blip. India's trade deficit, its energy dependency, and its reliance on foreign capital create persistent downward pressure on the currency. Holding 100% rupee-denominated assets is a losing trade over the next 5 years. Rule 5. Understand the difference between the India story and the India reality. The story is compelling. Young population, digital revolution, democratic stability. But the reality is messy. Unemployment, inequality, infrastructure gaps, bureaucratic delays. Do not confuse narrative with fundamentals. The FIIs are waking up to this gap. You should too. The $1.7 billion outflow on January 14th was not an anomaly. It was a signal that the foreign capital that inflated Indian asset prices over the last 5 years is now leaving. The party is over, the music has stopped, and the exits are getting crowded. This is not about being bearish on India long term. India has incredible potential, but potential does not pay the bills. And right now, the macroeconomic setup, the currency pressure, the valuation stretch, the geopolitical uncertainty, all point to a period of pain before we see the next phase of growth. The smart money has already adjusted. They have reduced their India weightings. They have hedged their currency exposure. They have moved capital to safer jurisdictions. The question is, have you? This is your favorite Asian analyst. The protocol is active. Class dismissed.